Taxes don't work the way you think they work. You have more agency than you realize. You have more influence over the size of your tax bill than you realize, and you have more opportunities to pay less than you realize.
What you don't know is costing you commas and zeros. Welcome to the Owner's Profit Playbook. I'm Pat Mancuso. Most entrepreneurs think their biggest challenge is growing revenue, but the real problem is the profit leaks hiding inside their business. On this show, we break down the strategies, structures, and financial blind spots that separate struggling operators from truly profitable businesses. Because building a business is one thing, but building a business that creates wealth, that's the real playbook.
Hello, everyone. My name is Pat Mancuso. Welcome back to the Owner's Profit Playbook, where we help businesses and owners and high-income wage earners stop reacting to money problems and start running a real strategy. Today's episode is especially important if you're someone who makes good money, W-2 income money, or business income, or both, and still feels like taxes are your biggest uncontrollable expense. Because here's the truth. Most people think taxes are just the cost of success. But what if that's not true? What if you're not paying what you owe, but what you by default into? That's today why we're breaking this down with someone who I am fortunate enough to have a business relationship with, also a co-author, part of a book that has been written on taxes. So I'm super excited today to talk with an individual who has been recognized. I'm not going to steal all this thunder, but he's been recognized as the funniest tax attorney in the country. And by my own admission, I've experienced that humor, but he's also one of the smartest and most recognized tax attorneys in the country. So Ed Lyon, welcome to the show.
Pat, I'm excited to be here. Thanks for an awfully nice introduction. I will clarify that when CNN called me the funniest tax guy in America, it was because nobody else wanted the job.
I love it. I love it. Well, is that because it has anything to do with taxes or attorney or both?
Well, taxes mostly. So
Yeah.
the thing is, there's nothing funny about paying more tax than you have to. And so many people, as you said, think that taxes are something that happened to them rather than something they have a measure of influence over. So if I do nothing else in this call today, in this conversation today, it is to help listeners rethink what taxes are and their role in the tax process.
Well, and Ed, my mantra is what you don't know is costing you commas and zeros. And I know today we're going to talk about what people don't know about tax mitigation, tax planning, maybe even things and fears that they have about taxes. And they're just actually, in some aspects, what I say is over tipping the government, right? They're tipping the government when in all actuality, there's things that they could be taken advantage of. So,
Sure.
Ed, before we get even tactical, I want to set the playing field here. Most people hear tax planning or tax mitigation, and they assume it's risky or aggressive. How would you respond to that?
So I would say that's the wrong spectrum. People look at tax planning and they say, oh, it must be aggressive, and I feel more conservative. And that's not really the spectrum we're operating on. We're operating on a completely different spectrum where most people are reactive. In fact, most tax people are reactive. They tell you how much you owe, but they don't tell you how to pay less. So the real spectrum is reactive and proactive. What things can you proactively do to pay less tax? And some of them bring with them zero audit risk at all. In fact, some of the strategies that we regularly employ with our clients will actually reduce the risk of being audited. The highest risk of being audited is business owners operating their business as a sole proprietorship. And in many cases, we will recommend a strategy called an S corporation, which minimizes employment tax, but it also takes the odds of being audited down by 90%. So in many cases, we're actually lowering the chance of being audited. We're working with a menu of dozens of different strategies. Some of those strategies do have an audit risk. And before we implement those strategies, we will explain what the audit risk is, what the consequences would be, and explain how you defend those strategies at audit. In the end, some clients feel very comfortable pushing into that territory when they know what the reality is.
Right.
Other clients don't. And you know what? That's fine. This is something really important that people need to understand. There is no right strategy to pay less. There is only the right fit for you to minimize your tax. It's the same way that in investing, some people buy whole life insurance because of the belts and suspenders protection. Some people buy crypto and they're comfortable with that volatility. But it doesn't mean that you're right or wrong. It's only a matter of finding the right fit for you. So even someone who is temperamentally conservative, temperamentally doesn't want to rock the boat, and temperamentally doesn't want to take on one of the scariest agencies in the government, has strategies that they can implement and create significant savings.
So would you say that fear, that the conversation around to take advantage of things and not take advantage of things, the word audit and their whole mindset around that is part of what some people come to the table with initially? It's just their fear of an audit.
Yeah, absolutely. To some degree or another, most of our clients don't want to poke the bear.
Right.
So we dig down into exactly what the strategies that we use rely on. For example, many strategies rely on something called depreciation. It's not IRS audit bait. In the big beautiful bill last year, Congress just restored a 100% bonus depreciation deduction and made it permanent. That's Congress's way of saying we want business owners to take advantage of this deduction because it helps them grow the economy. So
Exactly.
it's simply not audit bait. So when you're relying on strategies that are straight out of the Internal Revenue Code, we can absolutely show you how they are not audit bait.
And is this a fair statement? And if it's not, correct me. But if I'm a taxpayer, business owner, or individual, and I take advantage of a tax credit in the code, and I'm audited, and maybe the IRS disagrees with my qualifications for the tax credit, and I argue that I'm qualified, I'm not committing fraud or going to jail because I had a different interpretation than the IRS did.
No, absolutely not. So let's talk about that. The audit rate is under about 0.5%. Less than 1 out of 200 returns gets audited in any particular year. Now let's look at criminal prosecutions. The IRS typically refers about 1,000 cases a year to the Department of Justice for prosecution. That is, and it works out over the last 5 years, it's been about 12,000 cases out of 1.2 trillion tax returns that have been filed. So this is not fraud. This is not audit bait. If the IRS determines that you don't deserve a deduction, they will just send you a bill for the tax that you saved using that strategy. You can then appeal it within the IRS, or you can go to tax court. And in fact, in some IRS audits, they actually result in a refund right at the audit.
Right. So, and again, I want you to correct me. I mean, I think I have a pretty good knowledge base based on experience, but I want other people to hear this. There's actually different levels of audit. And is it not a fair assessment or statement that the initial level of audit is, hey, we need some more information, Mr. and Mrs. Taxpayer, on what you took as a deduction?
Yeah. Remember, an audit is the IRS calls it an examination. They are examining your return. In most cases, they're looking for some additional paperwork verification. For example, if you claim to be a real estate professional, that's a strategy that requires documenting 750 hours per year of participation in real estate activities. The IRS may want to see your documentation. So in most audits, you'll resolve those issues at that level. Your auditor is likely to be an accounting graduate, but not a CPA, not an enrolled agent, and they're not going to dig that deep. Now,
Right.
if you are General Motors or if you're Enron and the IRS suspects that you're engaged in fraud as a publicly traded company, then they'll bring in JDs and CPAs, they'll bring in the Top
Yep.
Gun. But the Top Guns are not going to audit car and truck expenses for a local business owner somewhere in the Midwest.
So let's put a ribbon on this in that even part of taking advantage of any type of tax credit or tax filing, it's important to document. You said that a couple of times. And then if you are to have any questions, in this case, an examination, that takes care of a lot of the questions.
Takes care of a lot of those questions, right? Documentation is key. That is how you audit proof your return. It doesn't necessarily mean you won't get audited, but it means that if you do get audited, your representative can take that documentation to the IRS and satisfy their questions. And by the way, I say your representative very deliberately. Do not represent yourself in front of the IRS. They are trained to ask innocent questions that will open potential new lines of inquiry.
And that's a mistake a lot of people make. And so I'm glad that you shared that. So real quickly, why do most professionals in this case, and we're not here to, throw CPAs and accountants under the bus, clearly, because there's amazing people, and we and our team and the services that we provide through Excel Empire, we've got amazing accountants and CPAs. But why do you think that the field, if you may, is more compliance focused than planning focused?
So a couple of big reasons. First of all, most clients don't need planning. Most clients are simply looking for compliance. If you are, if you're a firefighter married to an RN and you're making $110,000 a year and your only deduction is mortgage interest and it's not enough to justify itemizing, then there really is not a whole lot of planning that could be done at that level. That client was simply looking for compliance. Now, second reason, let's look at the typical tax preparer's business model. The typical tax preparer's business model involves sitting down with the client, agreeing to work together, getting the information sent in, preparing the taxes, reviewing the taxes, delivering the tax return to the client, and then moving on to the next client. We have a 10-week tax season in the United States that starts at the end of January and extends through April 15th. Most returns are filed with the IRS then, and tax preparers are busy preparing taxes, sometimes 60, 70, 80 hours a week. They don't have time to do planning. By the time they're done with your return, they're either exhausted from returns, they don't have the time, or they may not have the technical training or the proactive mindset to help you pay taxes. Some tax preparers just are very risk-averse conservative people. They're happy working in a cubicle, typing on a computer, putting the numbers in the boxes, and making sure everything lines up correctly. The world needs those people, too.
Right.
If there's a nuclear power plant down the river, I want the guy who's operating the nuclear power plant to be a detail weenie who is not thinking outside the box. But it does require a different mindset, a bit of a puzzle-solving mindset to do what we do with taxes, which is, again, we're not interested in just telling you how much you owe. We're interested in telling you how to pay less. And as your income rises, there are more and more opportunities for us to do that. Typically, we're working with business owners who are making $300,000 or more from their business. We're working with W-2 employees who are earning typically $600,000 and up. And once you get into the higher tax brackets, there are a lot of opportunities for investment vehicles, charitable vehicles, and things like that, where we can create some very nice savings.
So you mentioned the high income wage earners and the, $300,000 business owners. And I know we did a lot of work with the employee retention tax credit, as I know you did as well. And, we experience this, and that's where my passion comes from in what we do today, is that there was a lack of knowledge because of the amount of specialty in that area.
Mhm.
What's the danger in somebody assuming, hey, my CPA has got me covered, they're
Oh,
doing
don't worry
everything?
about all that. I mean, the danger is dollars and commas. So there's a pretty easy shorthand question that you can ask yourself to realize whether you've got a good proactive CPA or not. And that is to ask yourself, when's the last time your tax pro came to you with an idea to save money?
I love
The
that
answer,
question.
yeah, if the answer is never, you're probably paying too much. You're probably paying too much.
Yeah.
So, and it's not because the CPA is bad.
Right.
It's not, they're not necessarily dropping a ball. Many CPAs see compliance as their sole objective, not planning. So if the CPA hasn't been asked to do planning, don't be surprised when she doesn't do planning for you.
Right.
The real key is a collaboration between you and your advisor, and it's a collaboration that acknowledges where your business is. So a lot of business owners start their business, pick their CPA, pick their business entity, it's usually an LLC, and they never change.
Right.
And every year they think, oh, it's tax time, so I'm going to send my information to my accountant. And the accountant says, I'm going to push a button on my computer and I'm going to roll over the client's numbers to this year. And it's just nobody rethinking things. So what I find is many business owners just outgrow their accountant without realizing it. I had a conversation yesterday with a new business owner. He's been in business a couple of years. He's really fortunate and he's going to take home probably north of $20 million this year.
Wow.
And he's still working with his original CPA, but I can guarantee you that his original CPA has never filed a tax return for an individual making that kind of money before. And if you're gonna do something important, don't you want to do it with an expert who's done it before?
Right. And so you mentioned this earlier about tax time and tax season, and I don't know the numbers you may, but we certainly have lost a number of CPAs based upon the aging demographics, right? I mean, we have less people coming into the field, we have people exiting the field, so that compounds the problem.
It compounds the problem. Absolutely. We are all getting older. My hairline is receding, as is yours, and the CPA population is aging. When you're 70 years old, you don't want to work 70 hours a week during tax time anymore. And the number of younger people coming into the field is shrinking. Frankly, they're going to have a ton of opportunities. A lot of people are saying, oh, AI is going to do all those tax returns. Well, it's not there yet.
Yeah.
It's not there yet. Maybe it will be there down the road. But here's a funny story about AI and what it does for people. In medicine, radiology was the specialty that doctors expected would disappear first to AI because radiology is pattern recognition.
Sure.
You're looking at a scan and you're saying, is this a bruise or is this a green stick fracture? You're looking at an MRI and you're saying, is this, what kind of a tumor is this? Is this benign or is it contagious death cancer? So radiology is pattern recognition. AI should be able to do that pretty effectively. And what we're finding is that radiologists aren't going anywhere. They're spending less of their time looking at scans and they're spending more of their time communicating with patients. So as we move up the financial food chain to a planning-oriented practice, tax planners don't ever have to worry about being replaced by AI because they're the ones who take this information and communicate it to their clients, right? We talked about 5 minutes ago about risk and finding the appropriate fit for clients. Well, when clients are nervous about being audited, they don't want to just answer some questions for a robot. to go into a black, but they want to be able to talk with a human being, particularly the more affluent they get. You know, somebody who's worth $10 million doesn't want a robo advisor telling them what to do with their money. They want an actual human being with experience and with a little bit of gray hair,
Yep.
right? They
Yep.
don't want they don't want the 24-year-old who's using AI to write the code. So there will be a place for good accountants on the tax side and on the bookkeeping side as well. So most business owners don't really know how to read a P&L. They don't
Wait a minute.
understand.
Say that again. Say that again.
I know. Shocking, right?
It's so unbelievable.
Most business owners don't know how to read a profit and loss. They don't understand a balance sheet, and they couldn't even tell you what a statement of cash flows is. So they want guidance. If I'm a business owner and I'm grossing finally $1 million a year and I'm taking home $400,000 of it, I want to be able to look at my books and say, hey, am I paying too much in rent relative to what my peers are paying? Am I paying too much in payroll? Am I wasting money on office supplies? Is Brenda sneaking out reams of paper when I've left the office so that she can feed her kids' school computer printer? You know, people want help, and they want to be able to have a real discussion with a real person who has real empathy for their very real problems, and they will pay a premium for that.
Yeah. You know, you mentioned that, and of course, I exacerbated it, if you may, but there's a reason, because when you look, like, we've had a number of the, well, this is going to be kind of funny because, of course, we're in Minnesota and there's a lot of alleged fraud going on in Minnesota. But I can't tell you how many times I've read an article, just read one the other day about a business owner who was fraudulently bilked out of about $1.2 million. And the only reason they were bilked out $1.2 million is because they weren't paying attention to their financials, to their cash flow statement, to their balance sheet. And, you know, even down to a general ledger where they would have picked this up certainly a lot quicker than 3 years later. And now they're out $1.2 million. And of course, if they don't have insurance to cover that, now they're really out $1.2 million, right?
Yeah. Yeah.
It's crazy. So let me ask you your perspective on this. So part of validating what you're talking about, and again, most people without the knowledge don't understand. There's the code, the law, and then there's the guidance and the interpretation of it.
Right.
And there's thousands and thousands and thousands, and it changes daily. And so that's part of the challenge as well for practitioners.
Sure. So the code is like a skeleton. It's not fleshed out. So code section 162 says that business deductions include anything ordinary and necessary to the business. Well, that's a loophole big enough to drive a truck through. What exactly is ordinary and necessary? Well, there are Treasury regulations that discuss it. There are IRS publications that discuss it. And even then, sometimes taxpayers disagree with the IRS and have to go to tax court to discuss it. There was a case last week in the Fifth Circuit that's a really good example. So if you are a limited partner in a business, the tax code says you are not subject to self-employment tax on pass-through earnings you get from that business. That is the tax code. Pretty black and white.
Right.
Limited partner, no self-employment tax. Well, the IRS doesn't like that, and they say some limited partners actively participate in the business, and they should be subject to self-employment tax on their earnings. And that got to court, and tax court said, yeah, IRS interpretation sounds right. Fifth Circuit said, nope, we're going to read the law. The law says if you are a limited partner, you are not subject to self-employment tax. Doesn't say anything about active participation.
Right.
So in the Fifth Circuit, you don't have to pay. Now, there are similar cases coming up in other circuits, and there will probably end up being a circuit split, and we may end up seeing this issue go all the way to the Supreme Court. And people are going to be scratching their head thinking, I can read the tax code. It says limited partners don't pay self-employment tax. Why are we making a federal case of this?
Right. Well, and Ed, you just brought up one of the reasons that I certainly was excited when I was introduced to you and in the team and had the opportunity to partner, because the fact of the matter is you're a tax attorney, and yes, you can read the code and you can read the guidance, but this is what you study. This is what you live. It's what you practice in terms of helping business owners and high W-2 income, high W-2 wage earners
Yeah,
reduce their
I
tax.
really do need to get out more.
Well, listen, I'm co-authored on a book, and I got certified by you with this stuff, so I know you know your stuff.
Yeah, thank you. I appreciate that. Yeah, and here I am not studying the code right now, not learning about the changes, but communicating all of this on your podcast.
Yeah. So, I'm a taxpayer, and I filed taxes for the last 3 years, let's say. Can I go back if there's tax things that I should have maybe taken advantage of? Are there certain things that I can go back and take advantage of, even though it's 2, 3 years ago?
Yeah. There are things that you can do. I call them tax time machines. And all we need is a flux capacitor. And we can go back. So one, if you discover that there was an error on your tax return and you accidentally reported too much income, deductions should have been bigger or income should have been lower, you can amend a return over the last 3 years.
Yeah.
Then there are specific things that you can do. For example, if you have depreciated property and you discover that you've depreciated the property incorrectly, you can do something called a change in accounting method on that property. And you can go back and you can rescue deductions even beyond 3 years, even beyond the period where you can legally amend a return. If you bought a house to rent out in 2020 and you didn't depreciate it properly, you can do a change in accounting method sometime in 2026 and go back and rescue all the lost deductions all the way back to when you bought it in 2020. And then there are some strategies that will create credits that carry back in time, and you can use a credit from a transaction in 2026, carry it back, and get a refund of taxes that you paid as long as 3 years ago. So there are lots of various tax time machines in the code, and that's an important part of what we do.
Right.
Every time we sit down with a new client, we want to review previous tax returns and see if there's any way that we can rescue benefits from the past.
How often in your journey, let's say, how often do you meet with somebody and, as a percent, let's say you meet with people, that's the 100%. How often are you not able to find a strategy, whether they choose to take advantage of it or not? But how often do you find where whoever did their work missed opportunities as a percent?
It's over 90%, probably over 95% where they've missed opportunities. There's maybe 1 or 2 returns in 100 that I look at where I can't create some sort of substantial savings. Usually it's due to some sort of constraint on the part of the owner. Maybe they have partners who don't want to implement a particular strategy. Maybe they have a contractual arrangement with a franchisor that dictates how they operate their business and how they maintain their books and a sort of profitability margin. But once we get to a client who's in the 32% tax bracket or above, it's nearly 100% finding something that they haven't done that they could do. And then it's just a matter of showing them those opportunities and determining which are a fit.
Yeah. Well, it certainly needs to be said, and that's not just a one-time deal, because it's likely been going on for multiple years, and you start compounding that savings, or it's just the numbers are insane. So
the numbers can get pretty silly.
Yeah.
And that's a lot of fun. That's a lot of fun for me.
Well, it is, right? When you can bring, we'll say found or lost money, either way, when you can bring that conversation to an owner, it's cool. It's really cool in the ability to do that. So let's flip it a little bit and let's talk about offense in terms of taxes. when tax planning is done correctly, what actually changes for someone? And what I mean by that is this, like, let's talk about a couple maybe of high level concepts or strategies that you find commonly, not all the time, but are common ones that are missed.
So for business owners, we have two separate lines of defense. The first, because most business owners operate their business as a pass-through entity. It's a
Right.
proprietorship, a partnership, and an S corp. The money does not end up on taxed on an entity level return. It gets passed through to the individual. So the first level of defense, we're looking for strategies that we can avoid having to pass income through to the business owner's personal tax return.
Right.
And qualified retirement plans are a pretty good example of that. If you can put $100,000 into a defined benefit pension plan, it doesn't hit the personal tax return and it doesn't get taxed at least this year. Now, I'm not a big fan of qualified plans.
Right.
There are usually more tax advantaged alternative strategies for retirement, but simply using the qualified plan as an example of stopping income before it hits the 1040, that's a good example. Then the second line of defense is when income has hit the 1040 and we're looking for strategies to offset the income. Sometimes they're organized as charitable programs, sometimes they're organized as business opportunities, sometimes they're investment strategies, but we're looking for things that we can deduct against the client's income. In most cases, the client doesn't want to lock up that income. So if you're growing your business and you
Right.
made 300,000 last year and your goal is to make 600,000 in 2 years, you probably don't want to lock your money up in a retirement plan where you can't use it to grow your business. So we're looking for strategies that will increase your cash flow. And there are all sorts of business vehicles and special purpose vehicles that we can use to stop the income at the business level or create opportunities and create deductions at the personal level. Uh, Again, it all depends on the fit. Some people
Right.
like investment strategies, some people are charitably oriented and they're happy to make charitable contributions. Well, we have charitable strategies that can actually create more than $1 of deduction for every dollar that you give.
Yeah.
So it really it's a pretty big menu of strategies. It's enough that when I do a full-blown plan for a business owner client, I will actually guarantee the savings in writing.
Wait a minute. Wait a minute. Okay. So
Wait a minute.
wait a minute. Wait a minute. So, first of all, novel idea, and yet a great tax planning and tax mitigation folks. If you can't back up what you're going to do, then you shouldn't be doing it, right?
Yeah.
So when you say guarantee that, expand on that a little bit.
So let's say I'm sitting down with a business owner and she's paying $300,000 a year in taxes, and I think I can cut $100,000 from that tax bill. I will probably have multiple strategies. It won't be one single magic bullet.
Right.
It won't be a single weird trick that melts taxes away. It will be a suite of strategies. Then I would enter into a planning engagement with this client, and I would say, I guarantee to save $100,000. And then I would propose a fee, and it'll be a big fee. She's going to look at that and she's going to say, wow, that's a big number. And I'm going to say, yes, it is. The good news is you're not paying it out of your own pocket. It's coming out of the savings. Then at the end of the year, we're going to look and we're going to see, did we save the $100,000? If we did, great. Let's say we didn't. Let's say we only saved 80,000. We missed by 20%, so I'm going to refund 20% of that fee.
Wow. That's a novel
So
idea.
the ROI, she will get the promised ROI
Right.
regardless of how much she saves. Now, if we save $120,000, there's no additional fee. There's
Yeah.
no success fee. There's no commission. She's just gotten an even better value, and ideally, she's going to tell all her business owner friends how
Absolutely.
much we can save for that. So, what we're offering, this is really important, Pat. We are not just offering a service. We're offering an outcome,
Outcome. Yeah.
an outcome. That's what makes us different from nearly everybody else in the tax planning space. We're not just offering a plan, we're not just offering a service, we are offering an outcome, and we are guaranteeing that outcome in writing.
Yeah. And that's why, Ed, obviously, in what the reason that I brought you guys to the table and I partnered with Excel and with the entire team was I have so many people in all the work we did with ERC come to us and say, I'm looking for a new accountant, I'm looking for a new CPA, I feel like I overpay in taxes. And, obviously, and this would be true, I'm sure, for a lot of advisors. These are friends of mine. These are people I've known for 20, 15, 20, 30 years. And when we put our name on the line for ERC, I understood how important that was and understood how important it was to have the team behind us that we did. And this is the same thing, except ERC was a product, if you may, so to speak. It was an opportunity, a one-time opportunity, obviously related to COVID, et cetera. But this is what I'm most excited about is this isn't let's save you some taxes this year. This is really how do we help you build your wealth so through reducing your taxes legally and ethically. And we have a guarantee. It's so exciting.
It is. And let me clarify one thing, which I think will surprise viewers. My job is not actually to help clients pay less tax. I talked earlier about things that I could do, like putting money into a retirement plan that locks the money up where the client can't use it. That's not an outcome. That's not a good outcome for a client who's looking to grow her business.
Right.
So my real job is to help you accomplish your financial goals with a minimum of interference from tax.
Yeah.
And that means understanding where it is that you are and where you want to go. So when I sit down for a discovery call with a prospective client, which is where the process starts, I start by saying, tell me about yourself. We don't talk taxes until we're halfway through the conversation. I want to know who you are. I want to know what you want to be when you grow up. What are your financial goals? What are your family goals? If you own a business, do you want to sell the business someday? Or are your kids interested in the business and do you want to transition the business? I ran into a high school classmate this weekend who is seventh generation of a family business. We're obviously not prepared, with a client like that, I wouldn't prepare any plans to sell the business. This is literally a family heirloom. It's like grandpa's grandfather clock, except instead of dinging annoyingly, it sends money out for decade after decade after decade. So
can they adopt me?
It's a collaboration.
Yeah.
We don't just give a client a black box and say, here, this is your strategy, do this. We have a lot of very successful, very due diligence oriented clients. Any of our STEM clients, our doctors, our engineers, they don't want a black box. They want to understand what's going on.
Right.
They want to understand the risk as well as the reward. They want to understand why I think it's right for them, and they want to validate that. So when somebody presses us and does their due diligence and does their homework, that actually makes them a better client.
Yeah. So Ed, I'm hoping that as people are listening, they're getting excited about first and foremost how they may be able to look at taxes, tax planning, tax mitigation differently. But I want to bring up an opportunity and ask you to talk about it a little bit. In that, we're bringing you up to the Twin Cities in March, and
I'm excited. It's going to be a lot of fun. I haven't been to Minneapolis in 20 years. It'll be a whole new city. Go to places like Minneapolis or Austin that I haven't been in a while. I was like, wow, this looks different here.
We'll try to get rid of the snow by then. March is kind of one of those times we call it tournament time in the cities where we have all the high school tournaments and, so we'll hopefully maintain a little calmness in the weather. But you're coming up and you're going to spend a day. Actually, we have two different sessions we're going to be doing, a morning session and an afternoon session, and you're going to be talking about taxes. And so if somebody's listening right now, and we're going to have the invitation as part of the show notes, etc. But what are they going to get in those workshops?
So we're going to discuss a framework for beating the IRS legally. And we're going to talk about the 5 biggest obstacles to doing that. Most people who attend are going to be making at least one of those mistakes,
Right.
if not multiple mistakes. And we're going to talk about mindset as much as anything else. For example, you may think that your 401k is the key to your retirement success. And you may be right, but you may be wrong. And at the end of the presentation, you're going to know whether
Right.
you're right or whether you're wrong. So those are the sorts of things we're going to discuss. But as I said at the beginning of this podcast, my goal is to change the way you think about taxes.
Right.
In these sessions in March in Minneapolis, we're going to go into more depth on specific tax strategies, specific tax opportunities. We're not going to make you an expert in anything, but we're going to get you to the point where you can ask the right questions. So we're going to do it in detail, and we're going to do it live so that at the end of the presentation, you can ask me a question, or at the end of the presentation, you can schedule a time to sit down with the two of us and go into more detail.
And that's what I'm most excited about is you're staying, we're doing the event on the 24th and the 25th. We'll be scheduling one-on-one appointments for people to really go deeper with you, have these conversations before you jump on a plane later on that day. And that's what I'm most excited about, because I think when people really have the knowledge, they can make better decisions. And when they're making better decisions in terms of their money and building their wealth, that impacts more than just them, right? I mean, there's a rippling effect to it. So
Sure, taxes are a drag on every financial decision you make. It's like a boat moving through the water on one of those mythical 10,000 lakes. And the water is resistance on the boat. And if
right.
we can remove that friction, if we can remove that resistance, the boat is going to move faster. You're going to catch more fish. For a lot of people who don't do tax planning, fishing is like ice fishing. They got to cut a hole in the ice first before they can get to the fish. And when we do tax planning, we're cutting the hole in the ice for you.
Yeah. I don't understand that whole fishing thing, but that's a conversation over dinner when you come up. I live in 10,000 lakes, and it's a patience thing for me, but people love it here. So I want to do a little rapid fire. Okay. And I'm gonna give you a statement. First thing that comes to mind. One sign someone needs tax planning, not tax prep.
They feel like they're paying too much tax. If you think you're paying too much tax, you very likely
you are. Yeah.
Trust your gut. Yeah, trust your
Most
gut.
expensive phrase people say about taxes.
My accountant takes care of my taxes.
W-2 earners' biggest blind spot. High W-2 wage earners' biggest blind spot.
Not trying, giving up before they even try.
Yeah. Business owners' biggest missed opportunity.
How they organize their business in the first place. They make that decision when they go into business, and then they never rethink it. I sit down with clients, and they'll sometimes pull out their tax return, and I'll discover they're operating the same business that they've been operating in the same way since the 1980s.
Right.
Folks, things have changed.
Just a bit.
Just a little bit.
BBB change. I mean, we haven't even gotten into BBB, but we're going to definitely talk about that when you come up. And yeah, absolutely. This one I'll be interested to see your response. One question every person should ask their CPA but doesn't.
One question everybody should ask their CPA but doesn't. What more can I do to pay less?
And if their answer is I did everything, that I did everything.
They may be answering in good faith.
Yeah.
I did everything that I know to do, or I did everything that I feel comfortable doing. See, here's a big mistake that a lot of business owners make. Most business owners have a whole boardroom of advisors. There's an insurance person, there's an investment person, maybe there's a real estate person or a mortgage broker, there's an attorney, and there is a tax person, there's a CPA. Who is the most conservative member of that board of directors? Usually it's the CPA.
Right.
Usually it's the CPA. And yet the business owner hears the word tax and they think, oh, that's a tax question. I'm going to delegate that to the CPA. You have just taken an important business question and delegated it to the most risk-averse member of your team. That's not a true collaboration.
Right. Yeah.
What we do at Excel Empire is we encourage collaboration. We encourage communication. We have a quarterly chief tax officer conversation where we're doing nothing but figuring out ways to make sure you're as efficient as possible. We do no hourly billing anywhere in our business model. There is never a penalty for you to pick up the phone and get an answer before you make an expensive mistake.
Yeah. The thing I love about what we do at is, and we don't charge for this, is that we diagnose, right? We diagnose. We look at somebody's taxes and we look at what they're doing, how they're doing it. We look at things. You shared a story not too long ago with me about a client that came to you, and I think it was about a $40 million company. And I think the number you were able to help them save was about 11 million in taxes.
Yeah, that's bread and butter for me. So that sounds about right.
I love it. I love it. Okay, Ed, what's your final thought? Other than obviously, we'd love people to join us, and we'll have all the information on that event out shortly. What's your final statement, impact statement for somebody listening to the podcast?
Taxes don't work the way you think they work. You have more agency than you realize. You have more influence over the size of your tax bill than you realize, and you have more opportunities to pay less than you realize.
Yeah. And it's just a matter of knowing that, having that mindset, which gives you the opportunity then to take advantage of it.
Yeah. Well, unknown unknowns can really cost you.
And like I say, Ed, what you don't know is costing you commas and zeros. And it's just a matter of how many. So,
yep.
Well, Ed, as always, you have been amazing. We appreciate your time, and thank you so much for being here today.
Thanks for the opportunity, guys. I'm really looking forward to meeting as many of you as we can when I'm in Minneapolis, when I'm in the Twin Cities. Am I going to Minneapolis or am I going to the Twin Cities?
Well, yeah. So you're gonna land in one of the suburbs of the Twin Cities, and then we're gonna be in Minneapolis is the plan. And so you'll be in the Twin Cities because we may venture over to the other Twin City, which is St. Paul or one of those suburbs. So yeah, we're gonna. It's changed a little bit since you've been here.
Just as happy to work with people from St. Paul as Minneapolis or anywhere, frankly.
Yeah. When was the last time you were up here?
It was, I think it was maybe 2007.
OMG.
A long time ago.
Yeah. There's some new highways that weren't built when you were here, and some suburbs that didn't even exist that are now named. So it's going to be pretty cool. Well, Ed, thanks again. And as always, this is the Owner's Profit Playbook, where we stop guessing, start planning, and run smarter plays with our money. Thanks, everybody. Thanks again, Ed.
If you're serious about building a more profitable business, make sure you subscribe to the Owner's Profit Playbook so you never miss an episode. And if you know another business owner who could benefit from this conversation, share it with them. To learn more about how we help business owners uncover hidden opportunities and strengthen their financial strategy, visit mancusocg.com. And remember, what you don't know is costing you commas and zeros.